Welcome to the Threefold Real Estate Investing Podcast. This is the podcast where you'll not only learn how you can achieve massive success in multifamily real estate investing, but also how you can simultaneously pursue great relationships with your family and a better walk with God. You can achieve financial freedom through real estate investing without sacrificing the relationships that mean the most to you. Now, here's your host, Lee Yoder.
Welcome back, Threefold listeners. I hope you're having a great week. We do not have a great guest today. It's actually just me today, just doing a solo cast. Just want to talk about rising interest rates. I think this is something that's on everybody's radar. Everybody knows interest rates are going up. And I think you probably all know that this affects real estate. And the interest rates have risen a lot, so it's affecting real estate a lot. Now, you may be thinking, well, I'm looking around our neighborhood, maybe you're looking to buy a house and you're not seeing prices drop that much. Likely you are seeing them come down a little bit, or at least you're seeing maybe what they would say, like some of the froth come out of the market, which means just some of the hyper demand, right? So maybe houses are still selling pretty close to where they were selling 6 months ago, 12 months ago, but not, 30 offers, people not going crazy, not giving up their right to inspect the property first, right? So, but still, maybe it seems kind of high. Well, I would suggest that that's going to start coming down more and more and more. You're going to start to see it. We, in the commercial side, we here at Threefold, we buy apartment buildings. We are already seeing it. We are seeing prices come down and somewhat significantly. But so you may be thinking, well, that's awesome. Good for you, Lee. Good for Threefold. You guys are probably finding great deals. Not so much, because while the price is coming down, the interest rates are going up. And the interest rate is so important. It's going to affect your return so much, because your loan, your mortgage payment is going to be your biggest expense. And when the interest rate goes up, it raises your mortgage payment, right? Like, you probably know that with your own home, but I mean, you can just imagine, you're probably buying a, $3, $4, maybe $500,000 house. Interest rate going up is a big deal. Well, if you're buying a $3, $4, $5 million apartment, interest rate going up is an even bigger problem. And so I wanted to show you an example. Well, first of all, I'll give you an example of a property that we purchased. So we got a property under contract at the beginning of this year. We were moving, forward with it, moving through our due diligence period. We had a letter from our bank, the bank that we had already done a couple loans with, gave us our interest rate, our term, the length of our term. So 25-year term, the interest rate's fixed for 5 years. And then, we either need to refinance or sell. Interest rate was at 3.875. And that was already up a little bit. I think the loan before that, we were at 3.75. We have a loan at 3.58%. And I think our best loan is 3.5%. So rates were climbing a little bit, but still great rate, right? At 3.875. Well, the week or two before we were set to close, the bank reached out to us and said, we are going to have to raise your interest rate to 4.3875. So up 0.5%, right? And again, depending on what you know about real estate, that may not seem like that much. With this loan, so we purchased this property for $5.85 million, and we were getting a big rehab loan, $1.25 million. So we were all in for $7.1 million. 80% of that is $5.68 million. So that was going to be our loan. The difference in the mortgage, the annual payment, was $22,000 with that 0.5% rise in interest rates. All of our underwriting, everything we've done, all the projections we gave to our investors right before closing, we find out we are going to make, like, for sure, because this is a payment we definitely have to make, just based on the mortgage, we're going to make $22,000 less per year, because we're going to pay the bank $22,000 more per year in interest, just on that 0.5% rise in our interest rate. So you can see why interest rates are so important. Maybe if you didn't know this before, maybe now you see why people are freaking out, and why you're just seeing some of the carnage in the stock market, because, companies get loans and they roll over their loans. So when interest rates rise, it affects everybody. But this is an example how it affects commercial real estate. So $22,000 a year. Now, luckily, as we were going through our due diligence period, we were also realizing, gosh, rent keeps going up. And just in the 2 months that it took us from going under contract to closing, the market rate was going up. The average rate on the apartment complex was going up. And we were able to tell our investors, hey, yes, our expenses are going up just because of our mortgage, $22,000 more per year. we're seeing that the rise in rent is going up as well. And you can see, it's a 95 unit apartment. I'm going to do some quick math here, but let's say, we go back to our investors and we just say, rent is just $10 higher than we thought it was going to be 2 months ago. So, we can now expect to get $10 more out of each resident. It was more than that, but even if you just say $10 more per resident, that's over $11,000 per year, which doesn't make up for that 22, but you can see if we doubled it. So let's say we could raise rent $20. Now we've equaled that out. And so that's kind of what we were seeing. So it was an okay story. We didn't have any investors running for the exits or anything like that, but I just want to give you that real life example and tell you how it affected us. And I don't know if I gave dates, but we went under contract in March, early March. We end up closing in May. So that's, if you remember back, that's when interest rates really started taking off. And we were right in the middle of that. But again, still 4.3875. I think if you're in the market now, that's still a really good loan. We're getting quoted now 6 to 6.5% on an interest rate on a loan that we would want to go get to buy an apartment building. So want to give you another example. Okay. Now with interest rates at 6 to 6.5%, I still get deals. And again, prices are coming down. Cap rates are going up. And by cap rate going up, I mean, we might have bought something at a 5 cap or a 6 cap, which means what that cap rate means is if you were to buy it for all cash, that would be your return. But it's just an idea. Like if we bought this property for all cash at a 5 cap, our return would be a 5% return. Not great. But if we buy a 6 cap, it's 6% return. So you can see, so the higher the cap rate, the better you're doing as a buyer. As a seller, you're not doing as well because you're selling for less. So I'll get into the numbers more. It might make a little bit more sense. But 6 months ago, 12 months ago, cap rates were low, very compressed because interest rates were really low. And I'm going to show you why that makes cap rates low. But that basically just means there was a lot of demand for multifamily housing, a lot of demand for apartment buildings, and people were willing to pay really high prices and accept a lower return. Lower cap rate means lower return. Couple reasons for that. One, rent was going up. And so they were, everyone was projecting a rosy future, for good reason, but also cap rates really, really low. So just like I just showed you, our cap rate going up just 0.5% cost us $22,000 per year. Well, cap rates just kept going down. So if you're going the other direction, saving $22,000, another $22,000, right? As interest rates are going down, you can pay more for the property because your expenses are lower. So, right. So the profit of the property is better, right? So that's why everything was going in that direction. But now we're going in the opposite direction. So now interest rates are going up. So cap rates are actually starting to come up. So now you can buy things at a 7 cap. So I had a broker the other day, really good friend of mine, sent me a deal, looked like a pretty good deal. And he said, hey, it's selling at a 7 cap. And this is a very stabilized property. So not a ton of upside, but not a bunch of downside. So very safe. But it's selling at a 7 cap. And again, 6 months ago, 12 months ago, the 7 cap was awesome. I mean, for a stabilized property, I mean, are you kidding me? That's awesome. I looked into this deal, just did some quick underwriting. I have a very quick underwriting spreadsheet that I use, just an Excel spreadsheet to build out to kind of give me just a quick idea of what my returns are going to be. And if it looks good, then I can put it into my syndication underwriting tool that I use to really dive in. So I'm going to share my screen. If you're on a podcast, you won't be able to see this, but I'll explain what I'm looking at. If you're watching this on YouTube, by the way, all my podcast episodes are on YouTube, so check that out. But I've just got this quick underwriting spreadsheet, and I'd be happy to share this. So if you do get a chance to watch on YouTube and you want me to share this underwriting spreadsheet with you, I'd be more than happy to do that. But what we're looking at here, this was a 30 unit, so a small property here in Dayton, Ohio. We're here in Cincinnati, Dayton, Ohio, and they're looking for $2.7 million for it. You can go down, look down through here, my income and my expenses, basically the net operating income, which means the profit in the property before paying your mortgage. Okay, so this is before the mortgage. That's the thing. The cap rate, the NOI are not affected by the mortgage. Okay, so the NOI was $189,000, which means buying the property at $2.7 million shows you that we would be buying the property at a 7 cap. And the way to do that, the way to figure that out, if you're new to this, is do $189,000, which again, that's your net operating income or your profit before the mortgage. So it's not true profit because you haven't paid your mortgage yet, but it's the profit before the mortgage. Divide that by your cap rate or by your purchase price. Sorry, divide 189,000, which is your net operating income, by the purchase price, which is 2.7 million, and you get 0.07, which is your 7% cap rate. Okay, so sounds pretty good so far, right? 7% cap rate. If you've been in the market at all over the past couple of years, 7% is pretty good on a nice property. But today's interest rates are 6%. Okay. So I've got my interest rate set at 6%. So we scroll down. The annual debt service, so our mortgage payment for the year is $167,000, leaving us right under $22,000. Okay. So what does that mean? Well, yeah, $22,000 doesn't mean much to you, but our down payment on the loan is $540,000. We're going to bring some other money to the deal for closing costs. I have $50,000, just like kind of our reserve fund. You need to have a good reserve fund. Might even need more than $50,000, but let's just say it's $50,000. So we need to raise about $630,000. So a $22,000 return on $632,000, that's 3.5%. Is anybody getting excited about a 3.5% return? Now, why is that? Again, it's because of the interest rate. Yes, you're buying at a 7 cap, but your interest rate is a 6%. And one way to start to understand this is you want to see a big spread. You want a big spread between your cap rate and your interest rate. When interest rates were at 3.5%, like some of our loans are 3.5 to 3.75, or we had the one at 4.3875. When cap rates are that low, or when interest rates are that low, the cap rate of 7 is great because there's a big spread there. And I'm going to show you that in this sheet. Let's take the interest rate from 6% to 3.5%. Again, our annual mortgage payment is $167,000. Our profit is $22,000 for a cash on cash return. So return on our $632,000 that we put up for this deal. The cash on cash return is 3.5%. Not good. Okay, but we're going to change our interest rate from 6 to 3.5. Okay, so our mortgage payment went from $167,000 to $120, well, just under $130,000. So we're paying $37,000 less, which means we get to profit $37,000 more. Our profit is now a little over $59,000. So we're $37,000 on profit. Our cash on cash return, okay, on that same $632,000, takes the same amount to take the deal down. Now our cash on cash return is 9.36%. Okay. All I did was change the interest rate. Now you can see how powerful interest rates, and that's on a 30-unit deal. Okay. 30-unit deal for $2.7 million. You can imagine if you bought a 300-unit deal for $27 million, just add it, add a zero on all these, right? So instead of, going from $22,000 to $59,000, you're going from $220,000 to $590,000. So instead of a $37,000 increase, you're increasing your profit by $370,000. So the numbers just get bigger as you go bigger. But you can see interest rates are powerful. Just that little, interest rates have gone up so much that this is actually a historic period. How quickly and how much interest rates have risen, and you can see what it's doing to real estate. I've got this deal, coming through 6 months ago, definitely 12 months ago. Would have thought, my goodness, 7 cap, a 7% return on my money if I bought it all cash. The 7 cap is awesome. That's because interest rates were 3.5 to 4%. Now interest rates are 6.5, and you can see what it does to your cash flow. And we buy for cash flow. What's missing here is, I'm sure some of you out there that have done some of this. You're saying, well, Lee, okay, you're buying for $2.7 million, and your NOI, your profit before the mortgage is $189,000. But can't you increase that? Well, sure, maybe. Okay, and that's why this may still be a good deal. You may say, well, the net operating income is $189. So, with the 6% interest rate, the return that I showed you guys, that $22,000, which is a 3.5% return on money, that's year one. Okay, that's for 1 year. If we can take our NOI, because our income was $270,000, expenses $81,000. This is a weird deal. That's very low expenses, but it's because they were going to do a master lease. But let's say we can take our income from $270,000 to $300,000. Okay, so this is a value add. This is what you call a value add property, right? So our net operating income goes from 189 to 219. Now that same interest rate, our return goes from 22,000 to 52,000. Okay, so now we've got an 8.23% return. Okay, so that's a value add. So that's why this deal could still make sense. If you can increase your income by, what did we increase? We increased our income by 30,000. This is a 30 unit, so you need to go up $1,000 per unit per year. Okay, so less than $100 a month. It's still pretty good jump for a property like this. But if you could do that, now you're talking about 8.23% return. So there's still potential here, but I'm showing you you have to raise the income by 30,000 to get the same increase in return that you could get by lowering the interest rate from 6 to 3.5, right? And so that's what the interest rates have done. It just shows you how powerful that is. So I want to show you one other thing is what would make this a good deal for me. So if I don't think I can increase the income like that, okay, this isn't really a value add to me. All right. So I'm more like, I'm just gonna have to buy this at a better price. What price would make sense? Okay. Well, I showed you what I'm looking for is what this would look like when we moved it to a 3.5% interest rate, and our return on our investment, our cash on cash return was 9.36. So I want to see a return like that. What do we have to do to the price to give us a 9.36% return? We have to drop it by $450,000. Can you imagine the seller being excited about that? Like, hey, you want to sell it at a 7 cap. What we're looking for actually is an 8.4% cap rate, which is the 2.25. So you divide the same net operating income, the 189,000. I'm doing this real time here, but you take the 189,000. Again, that's your profit before your mortgage, divided by 0.084. Okay, so that's dividing by the cap rate. It gives you your purchase price of 2.25 million. Okay, what is that going to do for us? So now 2.25 million. So instead of borrowing 2.16 million, right? So now we only have to borrow 1.8. Okay, so the difference here is that we're borrowing $360,000 less. So we still have a 6% interest rate, but we're borrowing $360,000 less. So that decreases our payment, our mortgage payment, from $167,000 to $139,000. Okay, which leaves us with almost $50,000 in profit for the year, which now we're only raising $533,000. If we're at 2.7 million, we have to come up with 630,000, a little over that. Now, since we're buying for 2.25, we don't have to come up with 533,000. So we don't need as much profit to get a good cash on cash return. So our cash on cash return, our profit percentage is 9.34%, which is the same. So again, you can see the power of interest rates. Because we're at 6%, I now need to purchase this property for $450,000 less than I could have 12 months ago when the interest rate was 3.5%. So an interest rate of 3.5% gives me a 9.3% return on my money at 2.7 million. But now I have to buy it for 2.25 million to get that same 9.3% return on my money with an interest rate at 6%. So you can see the power of interest rates. And this is the power that our Federal Reserve has. And this is how our economy is set up now, where the Fed controls the interest rates. I'm not a fan of that. This is a discussion for another day. But I just wanted to show you the power of the interest rates and why it's a difficult time to buy right now. You can see with this deal, this guy, maybe he's been thinking about selling for the last 6 to 12 months. And in his mind, he's come up with this $2.7 million sale price. And that made sense back then. He's like, I'm selling at a 7 cap. That made sense when interest rates were 3.5%. Today, he's still selling at a 7 cap. But it doesn't make sense with a 6% interest rate, at least not to me, without this being a big value add play. So I hope that makes sense. I hope you got to see this on YouTube so you could see my underwriting tool and kind of see me go through those numbers. It's usually easier to understand numbers when you get to see them. If you're listening on podcasts, go check out the YouTube channel so you can see that. And like I said, I'd be more than happy to send this underwriting tool. It's just an Excel spreadsheet, but it's pretty simple, pretty self-intuitive. If you want to start looking at deals and underwriting, this is a great tool. I mean, this would work on single family, up to small to medium multifamily. It's not great for syndication. You need more of a more in-depth tool to do that, but be happy to send it to you. So hope that made sense. Reach out to us if you have questions. We're always available at info@threefoldrei.com. Hope you enjoyed this episode. Have a great week.
Thank you for joining us for another great episode. I hope you'll take action on what you've learned today. If you enjoyed today's show, please consider leaving Lee a 5-star rating and review. And check him out on threefoldrei.com. Until next time, 1 Timothy 6:17.